Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode features Todd Schwartz of OppFi. OppFi is a subprime lender. You may remember a show that I did with Jared Kaplan when OppFi was going public via SPAC. The results of the business were pretty disappointing, to say the least. They have churned through two CEOs. I happen to think it's an interesting conversation because Todd, the new CEO and owner of the majority of the company, is candid about the post-SPAC process and what happened. When we were talking about doing the show, I said, we got to talk about this stuff, otherwise we can't do it. He willingly agreed. So, for me, the reason that I wanted to have this conversation is this company specifically has really forced me to think about my views on usury laws and interest rate policy. And between this company and Tyrone V. Ross and I had a conversation way back in the beginning of the show. It's something that I've spent a lot of time thinking about, and the conversation that follows is the output. This episode is featured by Daloopa. Daloopa is founded by a former hedge fund analyst to bring simplicity into the investment process. Daloopa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. Daloopa scales the velocity of an investment team's idea generation. Analysts spend less time locating and manually inputting meaningful disclosures into Excel and more time synthesizing in the minutes after the print. Daloopa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Daloopa's data sheets include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Daloopa's Excel plugin can also update your existing models for the latest quarter in just a single click. Bulge bracket banks and major multi-managers are trusting Daloopa for use in initiating coverage, building and maintaining industry dashboards, and keeping their models up to date. This is an institutional product. It's institutional quality. The price is probably outside of the reach of most retail investors. If you are one of the prosumery type people and looking for a solution, I would suggest either Koyfin or Stratosphere. If you are an institutional person looking for high quality, quick, auditable data that you can see it on a cell, click the number, go directly to the source. Said differently, if you are trying to save time, Daloopa, and your time is valuable, Daloopa is the kind of product for you. Visit the link in the show notes to sign up and tell them that I sent you. That would be fantastic. In the meantime, nothing in this program is investment advice. Everything in the program is for entertainment and educational purposes only. Please consult your financial advisor before making investment decisions. And I hope you enjoy the episode. All right, ladies and gentlemen, thrilled to be joined by Todd Schwartz, CEO of OppFi. Todd, how you doing today?
Doing well. Thanks for having me on the show, Bill.
Yeah, man, you are more than welcome. We've spoken over the years. I guess, what has it been? Almost a year and a half now.
Yeah, coming up on a year and a half, I've been back as the CEO of OppFi.
Yeah, it's a nice episode to revisit. It's got a little bit of a different feel. It's not the excitement of a SPAC. It's the what has happened after one episode. But I'm excited to talk to you for a number of reasons. And I guess for those that don't know what OppFi does, do you want to give a little bit of background of OppFi? And to the extent you want to give any background on yourself, happy to have you do that.
Yeah, well, thanks. OppFi is a mission-driven, technologically advanced, vertically integrated servicer that broadens community banks' reach and provides credit access to underbanked consumers who lack traditional options. And that addressable market we've identified as between 57 to 60 million people, or 15 to 18% of the US population. When I came into the business, I founded this, back in 2011. I was in a pawn shop and I had this really clandestine experience where I saw a woman pawning a wedding ring off, and really, really had a profound effect on me. I said, hey, why is someone doing that? Why would someone have to pawn a family heirloom to meet their financial obligations? And it kind of took me down this rabbit hole of investigating credit scores and how people lack options, why they lack options. And the banks had been servicing the space with 31 billion of NSF and overdraft fees. That's still a very prevalent market today. It's come down, but sometimes there's repurposing of fees, so they're not called NSF or overdraft. But and there's also payday loans, title loans, and so really, at its core, OppFi is a mission-driven company. I set out to change that and give people better options, try to improve their financial health and stabilize their financial situation. So at its core, that's really what OppFi does.
What were you doing in a pawn shop?
So I had a friend from high school who he kind of reconnected with me in about 2010 timeframe. And we were kind of unthawing, if you remember, from the financial crisis. And I was like, what are you doing these days? And he said that he's working for these two brothers that own 2 to 3 pawn shops. And he's kind of like the manager of one of the stores in downtown Chicago. So I said, wow, that is really unique and something I've never heard or been in before. I'd love to grab lunch with you and go check it out. And so that's kind of how it all came about.
Me and a buddy once upon a time had a vision of a cash advance shop called Real Big Cash Advance, but that never came to fruition. But that was always something that I've kind of, I've looked into this space in the past, and I guess there's a couple. So why don't we go to your early days as starting this in Chicago? If I recall correctly, you actually had a storefront and you were meeting people face to face when you were extending loans, right?
Yeah, absolutely. So I didn't approach this the way a traditional company started in the technology space or the fintech space. A lot of times you go and raise a seed round and build the technology first, and then kind of figure out kind of the service level and the product and the profitability. I really started from literally ground zero, square one. Didn't know how to lend. Family had a customer service background. My father was in the call center business, outsourced call center, BPO business. So I had a little understanding of call centers and operations there, but didn't really understand lending. And when I first started, I said, the only real way I know how to do this is open a very, very cost-effective office. It was on the second floor of a building at Cicero and Peterson on the north side of Chicago. And I got a computer and a fax machine. I mean, I'm dating myself, making myself sound old here with a fax machine. But people were still using them.
Well, 2010, it's not that long ago.
Yeah, exactly.
We were on the iPhone 2 or something like that?
Yeah, I think people were still on BlackBerries at that point. So
yeah, that's right. There was still a debate as to whether or not the iPhone would become
kids don't even know what Nokia and BlackBerry are today. It's not even.
They'll never know the joy of playing the snake game on a Nokia.
The roller on the side, yeah, 100%. But got into the office, got the license. So we were a direct lender to start. So Illinois had a SELA license. There was also a payday lending license. They had 2 licenses. Most people went with the payday lending license because you could charge higher interest, they can make more money. I said, that is not a great product for the consumer. It's non-amortizing, it's pre-computed interest, it's small dollar, and it really doesn't improve their financial health or help the customer. So when I said the SELA Act, the APRs are much lower, but I like the structure of the product a lot better. Amortization, and then I designed the rest of the product with no prepayment penalties, no late fees, no origination fees. And my bet was, hey, if we look through the credit score and actually investigate the bank account and the job and the stability of the person, I feel we can offer a much better product, and then customers are going to tell their friends about us, their colleagues, and we're going to be able to spread this through word of mouth. And then also customers aren't going to feel like they're being taken advantage of. We're going to have less complaints. It's going to be a much better for you product. And that was kind of what I said. I couldn't prove it at the time, right? So 6 months later, after I got the licensing and a computer, I didn't really have any loan management system. I didn't even really understand ACH. It was really,
Oh my
yeah.
goodness.
So
what happened? Who do you lean on to get some of the back end going and the underwriting and stuff?
there was a gentleman who was a retired police officer from the pawn shop named John Peterson, who I hired to come help me get customers. He would send them over and then help me and kind of taught me a little bit about how it works. And I got the loan documents together, and it was pretty rough. I mean, the first month we did 4 loans. Can you imagine sitting in an office for 40 hours a week and only doing 4 original?
Well, I'll tell you what, it's better than doing 100 loans when you don't know what you're doing, because at least the 4 you get to figure out, okay, well, what's going on and what's the prepayment like and what am I actually getting into here?
Absolutely.
But yes, it would be a lot of downtime.
Yeah, and we originally did it through allotment. So customers were setting it up through their payroll to repay us before I kind of got into ACHing as an option. And it's funny, so like the first 5 customers were USPS or United States Postal Service customers. And I gave them...
As in like they worked for the USPS?
Yeah, they worked for the USPS.
Interesting.
Different various jobs in the USPS. These customers, I met them. They're great people. They're family people. They have a good job. If you look at the cost of raising a kid, the cost of autos, the cost of rent, everything's, gone up so significantly over the last 10 to 20 years, and the wages haven't kept up, right? So there's these unplanned expenses that come up, and that's why people need a good option, right, to solve that pain point and the timing of when it happens. A lot of people are living paycheck to paycheck. And so they were thrilled to see this product. They were like, I had to kind of explain that they're like, there's no fees, there's no origination fee, there's no late. They didn't really, I had to they were so grateful that they, referred their colleagues and family members. This is a funny story. So 4 people, I give them the bank account number. So they put that allotment into their payroll system. Little did I know that USPS has this thing in their payroll system where if more than 4 allotments are going to one bank account, they kick out all the allotments because they think it's fraud, right?
Huh.
So
not ideal.
I did 4 loans and got 0 payments, 0. So I was like, I woke up Friday morning because that was the pay of the USPS, and I look at the bank account, 0, and I'm like, I'm not doing well. So, I was I took $50,000 of my own money, and I was not telling anyone what I was doing because I was pretty sure it wasn't going to work. And I had a lot to learn. But, I think what I learned in those years was very, very important, right? I learned, why the customers need OppFi. I learned the scale of the problem. I learned that if you just treat people fairly and you're transparent about it, people like that consistency and just fairness, right? Yes, we're charging more than 36%, but we've never hid that. Like our APR is stated, in a term loan, and we have a TILA box and Reg Z and all that. Like we want it to be as transparent as possible. We are a for-profit business, but we said we're going to be as fair as possible in the totality of, we're going to report people's credit for free. We're going to give social impact tools for free. Like we want to design the best available product for people to help them.
What were your early APRs?
They varied as I was testing in from 60% to like 199% to 120. But it's interesting, Bill, about APR. People hear that and they're outraged, like, "Oh my gosh, how can you charge that?" I can say it in 2 different ways. But if you do $1,000 loan, right, at 99%, I ask people. The average person, I say, it's a 9-month loan, fully amortizing. What's the payback of that? Every single person's answer is roughly $1,000 you'd pay for that because they think 99%, it's 100% basically times 2. That's not how amortization works. So your average balance throughout the life of that loan is more like $500, right? Dollars is your
assuming you pay back, right?
There's also no late fees, no origination fees, and it's no prepayment penalties. So no prepayment penalties means somebody, if you acquire them and process them, right, there's cost to that. They can pay the loan off in 1 day and just pay 1 day of simple interest, which at a 99% rate was, I think, like $3 a day. So you could give someone $1,000 to fix their brakes, solve that problem before the weekend begins, get them back on the road Monday so they get their kids to school and work. for $3 a day, right? And so people could use the product how they wanted to. They could make an outsized payment on day 4 to buy down their interest rate essentially and prepay a lot of the principal. They could run it to term and then just pay what was owed on the contract. So I think people love that flexibility and ability to use it how they wanted without getting penalized for it. But what we did was, by no prepayment penalties, we incentivized good behavior. So we weren't making money off people who were not using the product incorrectly. We were making money off people who used the product correctly and responsibly. And that's a really, really big point early on that I discovered. A lot of these finance companies, if you get past like the 30 days no interest or the 90 days no interest, and then you go into where the fees start, you're essentially making most of your money off customers who didn't use that free period responsibly. And so I love the dynamic that when our customers do better, we do better. And that's kind of how we designed the product, early on.
Well, hang on. I want to double click that because I think that's really interesting. So there is a version of the world that I can craft against your company where I say, Todd is a predatory lender. It's 120% APR. This is total BS, right? Now, if we look at a $200 loan, for instance, what you're saying is you take, or 300 or whatever, you take out X dollars, you pay me back, you're paying the APR on the outstanding balance. Everything is up front. I don't charge you prepayment penalties. I don't charge you origination fees. I don't charge you any of this stuff. The other version of the world is I can maybe charge you a 36% APR, but on that $300 loan, I'm going to charge you a $10 or $20 origination fee. And if you look at how I'm incentivized, the true economics of the OppFi loan that you, Todd, came up with, your argument is this is actually far more beneficial to the customer. Is that basically your argument?
I mean, 100%. So I know I can offer a line of credit, like an open-ended product, gets rid of refinances, gets rid of the APR thing. I can bring the APR down and fee people and do that. It's an open-ended product. There's no amortization. I think that gets people trapped in debt. I do. I think our product is the best. Term loans with full amortization and all the product features I mentioned is the best for our customers. It's simple, it's easy to use, easy to understand. And that's why I really truly believe in it. Why we started to do a line of credit, we tested into it and we shut it down. We said the term loan with the simple stated terms and APR is the best for our customers and allows them to use it flexibly and responsibly.
Okay, so now you're Todd Schwartz, the officially somewhat successful subprime lender, and you go to your family dinner and your family's successful and you say, Dad, I'm a subprime lender. How does it resonate with the family?
Not good at first. You're doing what? I think a lot, this happens a lot, right? So people at first are like, what are you doing? Why would you bother with that? And frankly, I wanted to do something where it helped people. Like, yes, I could just be another option for credit card for the prime space. I could be another financing option for the prime space. I wanted to go where no one had gone before. I wanted to be an innovator in the space and solve a large scale problem. I told you before, it's 57 to 60 million people, 15 to 18% of the population lacks traditional options. A lot of these people have banks with the big four banks, Chase, BMO, PNC, a lot of these Wells, but they're not getting lent to. So they're using overdraft and NSF fees as a way to finance kind of their daily lives. And that's a very expensive way to do it. The APRs on that, right? If you do a $9 overdraft and you can charge $35, the APR on that's 2,000%, but it also doesn't help you in any way. It just puts you more behind the eight ball. So I said, we got to have a product that's best in class. We got to have the best in class service, transparency, which, one of the things we're really proud of is just how we talk to our customers and how we treat them, right? You can't always say yes, but you can always treat someone with dignity and respect. And that's something I've said since day one is, we can always tell someone why, hey, your bank account right now is not in the best standing. We really want to show that you can keep it positive and that you're more responsible it's not ethical right now for us to be giving you more credit when you have to kind of sort out some of these things, or your income's not stable right now. We can't you can't service this, so sometimes you have to be an advocate for the customer and tell them no, but you can do that respectfully. You don't have to be, a jerk about it. And so I think we've gotten really good at that and do it really unique. And that's why our NPS score is industry leading. And we've maintained that even at the scale we're at today.
So I'm sitting here thinking about your product, and one of the reasons I wanted to do this episode and what I've told you is following your company has really caused me to reframe how I think about interest rates and APR caps and what our policies are. And I guess one question that I continue to come back to is, why do you think the regulators are so focused on a 36% cap? And why has OppFi had, like, what you're saying makes sense to me. So why has OppFi had trouble maintaining its businesses or its business relationships in Illinois and California and some of these, I guess, for lack of a better term, blue states?
Yeah, I think it's politically expedient, right? So everybody focuses on APR. APR is the only metric that's looked at. If you look at the CFPB small dollar lending rule, we've been compliant with it since it was written, right? It has ability to pay calculations. We do that. It has.
Do you mind going into that a little bit? Like, do you know that off the top of your head, what those are?
Yeah, I mean, we look at people's gross income, their debt, and we look at their cash flow situation through the banks, and we derive ability to pay right through that, right? And even the CFPB came out recently with, they're encouraged by this Plaid and some of these bank verification tools where it's definitely expanding access to credit. That was my whole theory from day one. I used to go through bank statements on paper and score them. That was obviously very inefficient. We've now gotten that to the digitally score it. But that really was the theory I had, is if we investigate the customer and spend the time, we can lower the APRs and provide a better product. I know it's the gross to payment, so what their monthly payment is to what the gross income of the customer is. If you get that above 10%, you're going to start to see delinquency spike because they can't serve it. It's not servicing. So it's very important. I love that people talk about our AI, machine learning models and all that. It's like to start, I don't care what AI says. If somebody can't afford to service it, let's start there. They're not going to be able to pay you back, right? And so we got that right early and have always, been an advocate for that ability to pay, verifying income, stuff like that. So in our underwriting process, making sure people can actually pay it back and use it responsibly.
So where does tech and AI help you in your process? I mean, to your point, you were doing it by hand, so obviously efficiency, but kind of when did you adopt tech and how did you think about, okay, how can I make this a little bit more mechanized as opposed to me going through a paper statement?
Yeah, I mean, we took each part of the interaction or the process, right, from when they fill out the application to how we service and collect. And I think did it in a really smart way, right? We built the tech over time and we got the best technologies available for each process. And so today, we have a really innovative tech stack that allows for 72% of our customers to go through without talking to a person. One of the things I always say is, if you want to chat, we can chat with you. If you want to talk and just verify we're like a real company, we have people, standing by waiting to take a call. But the newer generation, obviously more tech savvy, can do all this on their phones, and they're able to process straight through without having to actually call or talk to somebody. So we kind of have that, how you want to be serviced, we will kind of work with you. And if you need more explanation or more transparency, you can call and we're able to explain more about the product and what you're signing up for.
Now, when I look at your delinquencies and your charge-offs, I mean, they're not inconsequential would be the best way I know how to say it. And I would say fairly substantial is another way to say it. So, I mean, there is a part of your business that has inherent risk in lending to anyone that is looking for a product at this level. Where does the deviation between non-performance and performance hit, and how quickly do you normally see that in the payment structures? Like, how, you know what I'm saying? Like,
yeah. So because of our loans are always less than the average book maturity on the book is less than a year, we're able to see it very quickly, right, and react very quickly. These products are not designed to be multi-year products. These products are designed to be less than a year on average. And we make sure that the product structure, we never mess with that. I mean, incrementally, month here, month there, but I mean, all in large, we've always offered a product that's less than 1 year in term. And we don't think that when you're doing loans of this size, they should ever be a 3-year, 4-year, 5-year product. That's not the purpose of this, right? But I think when you also look at it, what's important is some of the product features I mentioned. But we were talking about which part of the product was you were asking?
You were just saying that you look at people's ability to repay,
Okay.
and then I look at the charge-offs and say, okay, well, where does this deviation
That's
come
right.
from?
So if you look at a vintage, right? So if you blend a vintage, it's between 15 to 17%. Last year was an outlier, right? We probably had closer to 19 to 20 at a vintage level, but that does mean the metrics we report on the financial quarters is as a percentage of revenue, right? And so it appears a little bit higher as a percentage of revenue because when we originate stuff, the income comes after repayment, right? So it's delayed. So there's kind of that lag. But basically, we like to say 85% of the customers, right, are paying in full, paying off, or going on to another product, right? Because they're successful. Like obviously, when the refinance side, the only way to do that is if someone's paying back and is in good standing, right? That's very important that we make sure of that. So, and there's a benefit to the customer when they refinance. But yeah, I mean, charge-offs are something like we're looking to, if you're asking, like we're looking to lower charge-offs, get it back down to what it was in 19. In 2020, we were in the 20s, as a percentage of revenue. We've brought it down significantly from 2022 when inflation hit us pretty hard and our customers pretty hard. That shock inflation was probably the toughest period OppFi has ever experienced going through that. We had a situation where like our longstanding customers were having trouble paying us, right? Like our really good customers. And so that was a challenging time that we got through. We learned a lot from it though. And I think one of the things with some of those losses is we've learned a lot. Our credit modeling has gotten exponentially better. And you mentioned AI. We don't have machine learning models, but we use AI tools to analyze data, right? It helps you analyze data a lot quicker and make decisions a lot quicker. It's a tough one because we want the delinquency rate to be low, but we also are a credit access business, right? Our job is to expand credit access. So we are constantly testing how can we make this customer who may be deemed too risky or the charge-off rates are too high, how can we, if we look at something else, if we look at this data set a little differently, can we make it work in our system? And so we've done some of that this year successfully, actually. And a lot of it comes through the bank, looking at the bank and looking at their responsibility of using the product. We've been able to expand credit access while bringing delinquency down. That's the gold standard. But this is something that I think about daily and something that we are looking at ways to reduce price for customers and reduce delinquency overall is a big theme for this year and for next year.
Now, when we talk about credit access, I can't help but think of the study that you all provided, I asked for, that came out of Illinois that showed when the APR was capped at 36%, credit access for subprime decreased. Now, the first reaction that I had was, well, that obviously makes sense. And that's neither good nor bad in a vacuum. What I thought was very interesting, and I may have these numbers off, but I think I'm directionally correct. I think 11% of people said that they were better off financially post the APR cap. And I think 40% said that they were worse off financially.
Yeah, I mean, exactly. There was 44%. I have it up actually now. So number of loans to subprime borrowers decreased by 44%, right? And then the average loan size increased by 40%, which means people were just giving people a lot larger products that they probably didn't need and at much longer durations. But yeah, to your point, only 11% of the respondents answered their financial well-being increased following the interest rate cap. And 79% answered they wanted the option to return to their previous lender, which was us. I mean, we were probably the largest non-prime or underbanked lender in the state at the time. I think back to what we were talking about earlier, Bill, interest rate caps are politically expedient. It's a great talking point when you're on the campaign trail to say, I'm gonna lower the price, or I'm gonna give you free student, whatever it is. It's a great talking point. And it's similar, I compare this to affordable housing, right? Rent control. Right? It's been done in various cities around the country. It never works. And the reason is if you look at University of Chicago's down the street, right? Milton Friedman, the father of modern economics, you need more supply. Supply solves price, right? So if there's competition in the private sector, you're going to bring price down. If there's more options, price comes down. So you can do stuff. There can be like ability to repay, making sure that customers only don't have debts. Like there can be guardrails. We call them smart consumer protection guardrails, and we're all for that. And we actually have, weighed in and given suggestions of how to better regulate. But when you just shut off interest, when you just cap interest rates with no other mechanisms, all it does is really just cuts off credit access completely. And then people, we in Illinois, we did a survey that and it's not something we can just release because it wasn't scientific, but we just basically queried our customers after we left the state, said, what's going on? How do you feel? And a lot of them said, I'm behind on bills. I'm getting foreclosed on. I'm going across state lines to Indiana to get a payday loan. That was the most discouraging one. And that's the unintended consequences we talk about is if you don't have a rich uncle, if you don't have a family member, if you don't win the lottery, where do you go if your credit score is 620? And so, yes, there is a school of thought, okay, well, they don't deserve credit. They shouldn't get credit. But I just find it hard to believe that someone could say that to somebody when they're in a situation where they need $1,000 and they need a transparent, regulated, federally and state regulated bank to provide the loan, where we are a best in class servicer to provide that to them, right? In an efficient way. I think people should have that option, right? As long as it's being done, like I said, with the guardrails and the protections that I'm talking about and the favorability of the product. And this study you're referring to is a nonpartisan study that was done and really just highlights when states go to the interest rate cap or the predominant economic interest test, it really just cuts off access. And that's really, it's pretty documented now, but in California, what we're protecting against. In California, there's 7.2 million people that fall into our customer set that if they completely capped rates and PEI tested, they would just have no options, right? It would just put them in a loan desert, we call it, or a credit desert, which is what's happened in some of these states. We go on the ground and actually talk to the state legislators. And I'm not going to say the state, but one of the times we asked them, hey, where do people go when you enact this law? What are they supposed to do? And we actually got a response, which was a little troubling, in that they can go get another job or they can go donate blood plasma. And I was just shocked at how out of touch that sounded. That's just not real world, right? What if they already have two jobs? Then they have to get a third. I mean, I don't even know if there's hours in the day, right? To be able to do that. And so we're not saying if you can get cheaper credit, and that's why we have the turn-up program, Bill, is we screen people against lower cost lenders and we get a match rate of about 11%, right? And about a third of those people get approved for lower cost of capital. So we're not saying you should use our product exclusively. If you can get lower cost of capital, absolutely. And we encourage that. That's a graduation in a sense for us. But if there's not a lot of high quality options, we are the best available option, right? And we want to be there for people and be reliable for them as an option, a true option with protections, consumer protections, and transparency.
Yeah, I think there's two interesting things that people may not know. One, the Turn Up program is a program that OppFi runs that when somebody applies for a loan, you all shop it to banks to see if a bank is willing to extend the credit. And only after they say no does OppFi make the loan. And two, the APR bill in Illinois had a carve out for banks and credit unions to step in and provide the credit, and they don't do it.
Yeah, no, they don't. And a lot of the banks that we partner with that have the appetite to expand credit access and have a similar goal as to us, they don't have the infrastructure or the servicing capabilities or the compliance and regulatory capabilities that's why the partnerships are so important, right, for expanding credit access. They're really good on the regulatory side, on the licensing side, and deposit side, but we're vertically integrated that has the technology and the experience to be able to actually execute it. And so that's why the partnerships have been a very great way to expand credit access in a compliant way.
Yeah, I mean, a skeptic might argue it's state regulatory arbitrage. A lot of those banks are located in Utah when you see the fintech partners. And I've heard a lot of investors that I grew up reading and respect have said that subprime is an area that they're not willing to go to because it feels too seedy to them. And I had this default belief that they were correct because these were people that I looked up to. And I can't help but think after a couple of years of thinking about this, that's a pretty ivory tower way to look at the world. And I actually find it kind of offensive that is a viewpoint, but I'm fine for people to disagree. But I am not, I said on Twitter, I think the rate caps are the predator, not the lender.
I appreciate that, and it's glad that you have an open mind and actually gathered the information. I mean, there's going to be people that disagree, right? There's people that these people should not have any credit or whatever, and government's the solution. I don't agree with that, right? I agree that the private sector is needed here, and back to what I said earlier, more supply is needed, right? I'm not saying we should be the only solution. I'm saying there should be competition, which drives down price. And you should have to win the customer's loyalty in business, right? And with the consumer protections and all the stuff I talked about. But that's really, what it's a philosophy of how to govern and just, what the solution, where the solution is going to come from. And so I think that it's pretty clear that I think people should have a choice, access and choice.
Yeah. I think it's funny that even when I articulated a position that I've thought about for a while, I crossed my arms to somewhat protect myself from what I felt people were thinking when I said it.
Did you put up a shield? A shield?
Yeah, that's right. Yeah.
Well, I would be crossing my arms 100% of the time if that was.
Well, I suspect when you were starting, it wasn't the easiest thing to tell your friends. I mean, that's why I asked. When you went to dinner or whatever, you're telling your wife, this is what I'm getting into. How many people kind of looked at you and said, like, here's a guy from a successful family going into subprime. What a schmuck. But that's not reality, I don't believe.
Absolutely. And it does take some education. It takes a lot of understanding the totality of the circumstances, what other options are out there, what happens if they don't have it, right? Like that, those are all sets of facts that are not readily available that I just try to convey to people and they can make their own decision, right? I'm not going to, as long as you can have a discussion and they're willing to listen, right? Like some people may just not agree, because they just think it's the cost is too high or whatever else. But it's ultimately I'll just arm them with the facts and what I think, and they can make their decision.
Yeah. So, okay, you're successful, and 2020 hits. What's behind the thinking to go public, and why via SPAC?
Yeah, I mean, we came off of an unbelievable 2019. Like things were really clicking. Our team we hired up a good management team, and we were well positioned. And then, we had talked about, hey, what's next for OppFi, right? On the capital markets side, on the growth side, where do we go from here? And we had started to think about other products at the time in late 19, early 20, and essentially, hey, have such a great loyalty, we have such great service and trust with our customers. What if we surround them with some other products, right? That can be beneficial, whether it's a graduation credit card, whether it's a neobank account, and help them more in their bill pay tools, stuff like that to really help the customer. I think that was a great vision, right? It made a lot of sense at the time. It was a much different world, right? You were getting credit for a lot of this evaluation, and you didn't have to necessarily prove it yet. You could kind of have the plan and start to go in that direction, and people were evaluating based on that. 2020 set and it was almost panic, thinking, oh my gosh, no one's going to pay anymore, and we're not going to have a business, and this whole business we created, this great business may go away. I don't know. The government stepped in. It ended up being like one of our lowest delinquency rates and charge-off rates ever. There was no growth because people were kind of at home, and there wasn't really, people weren't driving. Our biggest use case.
Yeah, and they were showered in stimulus, right? There wasn't as much demand.
But the repayment rates were off the charts. And so the year went completely different than we had from when this kind of happened till the summer. It completely threw us for a loop, and I think everybody, but it ended up being a positive experience. Like we were a full in-person company, including the call center, right? And we went remote in 3 business days. Right. I mean, so, credit to the team for having we used our disaster recovery plan basically to go remote. It's not a corporate, it's a heavy operations business, right? You have a lot of different things happening in the background operationally that are required to be able to kind of present to a customer pretty seamlessly and be able to offer this service. So it was a scary time, but we got through it. And I think back on the backs of just like, hey, people always asked when things don't go well, what's going to happen to credit? And we were like, well, look, things went really well and we didn't grow as fast, but yeah, credit held up really strong. And obviously the government stimulus helped. So it really teed up. We started talking late 2020 to FG&A that was introduced to us through a banker. And we kind of aligned. Joe Moglia had some financial service background with Ameritrade. He had worked there as the CEO. And really got to meet him and his team and really aligned around, like, he's like, a lot of these SPACs aren't going to make it. He kind of saw that early on. He saw that OppFi was a real business model. Like, it was a real business, right? That had growth, it had profitability, but it was also a mission-driven company that was doing the right thing and helping, and he kind of, it's funny, Joe in his speeches, if you've ever heard him speak, he always talks about like the little guy, the underdog. And that's really his story. And it just aligned really nicely with OppFi. And so we kind of, started to work on that. It was a lot of work to get from being a private business to a public in July that year. But it was an exciting time. I mean, going public, ringing the bell at the NYSE, seeing OppFi's name all over the NYSE floor and the banner out front on Broad Street. I mean, it's surreal. Like, yeah, there's nothing else to describe it. I was in tears. Like, I couldn't believe it. From a one-room office doing 4 loans where no one paid me to this 10 years later was a milestone that I don't think I'll ever top. But it was and it was all done to help people and mission driven. We never wavered from that. And that's what made me proud, was we didn't like sacrifice our morals or our integrity to get there, right? We just did what we always said we were going to do and delivered for the customer. But, I think once you become public, you're public. And it is a different world. Like, when I tell you that, and I think, we had this vision, like I said, that we were surrounding the customer with products. And what I quickly saw was, number one, I'm in the investment world. So when I went away as CEO, I got into investment world. I'm actually sitting here at, Schwartz Capital has a private equity arm called Strand Equity Partners. So I started to get into investing and started to get into a little bit like, investing, you have to understand what's going on economically, and you have to understand like the economy, and really kind of built that muscle over the 4 or 5 years that I wasn't CEO, and investing and learning about investment strategy and everything that kind of comes, which really positioned me well as I came back as CEO. I didn't even realize it, how much I had learned. But when you're navigating a public company, a lot of this is strategy and thinking about the positioning of the company, how you're going to message the company, what you're going to be doing. And a lot of it has to, pulls from some of that investment experience in real estate and private equity that I gained kind of as I was executive chairman. I was still very involved with the company, obviously, but not the day-to-day CEO. I think like when I saw the writing on the wall in 21 credit, I saw that inflation was coming. I saw that interest rates were probably going to go. I saw all these things coming, and knew that it was going to be a really tough operating period where we kind of had to bear down and go back to the basics and roll up our sleeves. And we're going to have to get much more efficient. Our overhead as a percentage of revenue was in like the 45% range at the time, or even higher, I think. Today we're at 30. I think our last quarter we were at 34%. So we had to get more efficient. We had to get rid of a lot of the initiatives we were doing and focus on our core business, which is this great business, and continue to deliver value to our customers, keep our NPS scores high. And I thought I was well positioned to kind of come back in and do that, right? I had enough to do on the other side of the house, but I thought like this was my calling, and I wasn't going to let something I had worked 10 years to get to and had such a high point, like less than a year, 6 months before, kind of just dwindle and not reach its maximum potential, right? And so I wanted to take the reins back and control that. And it was tough. Like 2022 is not easy. I come in at the hardest parts, the beginning, and then I'm a masochist a little bit. But I learned an unbelievable amount last year. And it's funny because people say you learn from successes. You don't. You learn from I don't know about failure, but you learn when things don't go well, right? And what not to do. And that's at least how I learned. And so coming out of last year, just surviving, we remained profitable. Obviously, it wasn't the profitability we were used to, but we remained profitable for 8 straight years, which was big. We got our balance sheet in good shape, and we came out of the year with a really strong credit model, really lean, efficient team. And, a lot of the strategic decision making we did, the year before is what's really led up to, kind of 3 really good quarters here and kind of a resurgence of OppFi and the stock market.
Let me give you the outside view, and you don't have to share what you don't want to, but maybe you can refute, or I'll keep my arms open for this one because I'm actually not that defensive about it. But to me, it looks like a scenario where leading up to the SPAC, there's a lot of excitement, valuations are high, there's a lot of growth, there's a lot of hiring. And one of the very interesting things that I've thought about this business since following it is, to your point, 2020's vintage performed so well in large part because of stimulus. And then you get to this part in a credit cycle, and I wish I had foreseen it, but whatever. And I had locked myself up, so whatever, it doesn't matter. But that's neither here nor there. Turns out you have adverse selection in the people that are still applying for credit at the same time that the incentives are to push growth because the valuation and growth investors want it. And then, I don't know, for whatever reason, you all, like Jared decided to leave. I think that my perception of reality is it was a lot more fun building the business and going public than running a business that was failing to meet some of the projections. And then there was a hiccup at the CEO role. And I think what happened was the CEO that came in was very growth focused. And I think that you saw what was going on in credit, your perception of macro, and very quickly said to yourself, if we go full blown growth right now, the whole firm could be put at risk. And one of the reasons that I follow you, respect you, and hopped on the earnings call to thank you, I don't think it's an easy decision to replace a CEO so quickly in a public company, but you still own a large percentage of this company, and it's clear that it's your baby and it's something you care about. And I think you came in to save it, for lack of a better term. And now you're on the other end of it. And I would imagine that must have been a very interesting place to be. And from a business quality perspective, you're obviously financial and have credit risk, but to go through that and survive, I think says a lot about a small company.
Yeah, I mean, it was the, besides Operation Choke Point in the early days, when we almost didn't have the ability to take payments from customers. I mean, this was by far and away the most challenging period ever in the history of the business for multiple reasons, right? Almost it all happened at once too, right? It was kind of the California thing, and then we placed our major financing partner, right, Ares.
Yeah, California came down on you like right after the SPAC,
my first
right?
Decision, day one decision to protect ourselves. We had to do something there that was unimaginable before. But we were like, hey, we think we're in the right here. We don't, they were, and we were kind of getting sick of hearing these pejorative terms, rent to bank and all this stuff, where if you look at the structure of these agreements, like these things take a year to negotiate. They are very detailed. You have large groups of teams that interact with these banks on a daily basis, sharing information from a regulatory compliance standpoint. And like to say that, to throw these pejorative terms around and say that it's a sham and it's like this and is just not correct. Like that you haven't done your homework. Like these agreements are legitimate. The banks have equity in these loans. They're audited by the FDIC, overseen by the CFPB. We're overseen by the CFPB. The amount of audits, we just from the tech standpoint, InfoSec security, data privacy, like everything's thought through and spelled out in these agreements and executed daily, right, between these partnerships. And so, I really was kind of tired of just hearing that, that like making people, rent a bank or whatever it is. They called us everything in the complaint. And I was like, I'm done. I'm going to defend credit access for 7.2 million people in California. And I want to have a chance here. And obviously, the venue in LA County was not the most, but I said, well, we're on the right side of this. We have the facts and we're going to present our case the best of our ability. And so it was a tough decision, but it's something we had to do. And, it's kind of playing out right now. So, but we'll see how that goes. But I do feel proud, regardless of outcome, that we defended ourselves and we defended credit access. That's really what we set out to do. And at the end of the day, it's part of our mission. So I feel proud that we were right there for our customers and have been continued to operate in the state as this goes on. But yeah, is 2022.
And then you're dealing with DC at the same time, right? I mean, this is the hard thing. Like you're getting, people are coming at you like crazy.
DC is a tough one. It's so small, DC though, that like the cost and we decided not to pursue anything there because it's just such a small little population center, and it's one that there was another. We kind of got word that they were kind of talking to some other lenders, and so like we didn't. It was early on. I wasn't back as CEO yet, so we exited DC. But when we kind of came about with California, we were ready, and we said, hey, we're going to defend this and do the best of our ability. So, yeah.
Yeah, so you're working through regulatory battles at the same time that you're working through a credit book that was probably the most challenged credit book that you've seen since you were probably in your early days and had no payments with those four customers.
What's really funny is I come back in and the 2021 second half vintage from July on was a disaster, right? Like we did everything right. Like we were testing neobanks and the segments of customers. So you usually have a mix shift of customers. It's from one to five really is where we exist. Five being the riskiest, one being the best, as far as credit goes. And we were like to your point, the upstarts, the lending clubs, because credit was so good and it was such an equity rich environment. Everyone's going public trying to show growth, in these SPAC mergers and whatever else. They were grabbing our best customers. Like we were not even seeing segment ones, which for a portfolio or a book of business are very important, right, to credit and to profitability. And so we were just originating like fives, sixes, which we had never really historically made a large portion. I mean, but in 2000.
Now, can I stop you real quick? Because I'm curious, right? You own this company for real. I mean, what's the publicly traded float is tight.
Yeah.
I mean, this is your own equity, right?
Yeah, we take control. Yep, the business.
So why, I guess the answer was you weren't running it, but why were you okay going to that? So, like how much was, my real question is how much was being public and going public and the incentive to hit those targets? How much did that drive
100%.
Maybe suboptimal?
If we were private, I don't think we would have had the pressure, right? We would have just said, hey, the growth's not there. I mean, we were not only paying a higher price, we were paying like $250 per at that time. The credit got away from us in the sense that like we'd shown the street. And so the last thing you want to do is get out and then crash your stock price right after. I mean, it's problematic for a lot of reasons, right? And so
what are some of those reasons in case people don't know? I'm curious to hear your take.
I mean, there's, plaintiff lawyers that prey on that and they're going to file suits on you that, it was misconstrued or you sent wrong information, not factoring in any of the macroeconomic things that are happening, but also just like, you have these people who stayed on with the SPAC. So everyone knows like a SPAC's a blank check company. They have a pool of capital. A lot of people redeem, right, from a SPAC. Like they say, I'm not going to go through with the combination of the businesses. Almost half of our SPAC, and considering we didn't have a pipe, that was a really, a great vote of confidence that people were willing to stay in. Ultimately, like I'm a fiduciary to do right by shareholders, right? I'm obviously also a shareholder, so I'm super aligned with that. But also the people who took the bet on OppFi and believed in our story and all the work we've done. We wanted to make sure. So, but we soon realized that we were just going to have to be honest and be forthcoming to the street and just kind of tell them, hey, this is what we're seeing and this is, how. And what nobody knows is we had been course correcting from like December 21 on credit and originations. And we were cutting and also like reducing acquisition costs. And it got, so just to give some people an idea, in 2019, 40% of new originations came from segment 4 customers. Today, it's like 1%. So like we said, okay, if we don't originate 5, 6, and 7s, which we did really quickly, like in January and in December, we're going to be way ahead of the pack, right? So we thought we had corrected it, and we're going to be 6 months ahead of before everyone else realizes. What ended up happening was we had to go down to like segment 3. So, and segment 3 and 4 are large segments. Like a lot of the people fall into those segments. And so if we added segment 4 back today, I mean, we could grow. I mean, the rates of growth would go back to like some of the early day rates where like I don't want to say double the business, but it would be a huge opportunity if credit started to behave in segment 4. That's not there right now with interest costs and with everything else going on in credit. It's better. Credit's looking better, but it's not, there at the 2019 rates. But you also had zero interest rates, super low unemployment, a lot of growth in the economy. People were spending, stuff like that. So, but yeah, so we had to cut much deeper. And then also one thing that was just not ever forecasted, we come out of the year, we make the cut, credit's looking really good. It looked really good. Part of it's tax refund season. So it was a head fake. And then all of a sudden in May, things deteriorated at a rate like we had never seen. In a 2-week time period, of course, it was like I was out of town doing meetings somewhere, and like it was while I was not like like sitting at the computer screen watching so closely. And I come back, I'm like, what just happened? How is this? Are we going to be able to get this? And that's when we knew we had to make some really serious operational and credit decisions, and we did so. Which basically sacrificed profitability for 2022. But I think what we did was we built trust, right? So we told them, like, we could have let refinances continue to run and probably generated more profit in 2022, but it would have made 2023 a lot less, we would have had to deal with a lot of the credit stuff still. I said, I want to get rid of this. I just want to start fresh. We got to get our balance sheet in good shape and just be honest and straightforward and forthcoming to the street and our investors. And we did that. And obviously that was probably the lowest point, right? When we came out and I think it was June or July, but we had been correcting like for 5, 6 months. And, part of the issue is when you originate, you need 30 to 45 days to get your first real read on payments. And so it's a little bit delayed as you go. So, we did the best we could. I think, in hindsight, if we weren't public or for other things, we might have been more in December. We probably would have cut a lot deeper and just been like, hey, this is not the time to grow and really, let's focus on operations efficiency and what we're doing. But we got it right eventually, and that's what's important. And we made it through to the other side. And I think there's a lot of learnings from our team. And the fact that I went through it with our whole management team now that's intact and that worked through that and has now seen both sides of the coin is really powerful. When you kind of go to war with someone, it's like a war story. You can talk about, hey, remember last year we were biting our nails and we were running through this, and it was no one was listening to us on the street because you had breached the trust, right, of investors and analysts, and we got to build that trust back. So we set out and we said we're going to do this, we're going to do this, we're going to do this. If you go back, we said we're going to have OpEx as a percentage of revenue here, we're going to have credit as a percentage of revenue here. We're going to get our acquisition costs down, and we kind of just did what we said we were going to do. And that's, I think, ultimately, like right now is we're getting that trust back. People are starting to believe again that we know what we're doing, and they believe in management's ability to execute.
How do you think about on a go forward basis? I mean, it seems to me that this is, I think about this kind of like insurance, right? So this seems like a hard lending market right now where it's kind of if you're the capital provider, you're in a better place than you otherwise would have been in, say, 2021, where the buyer of the credit had more bargaining power. How do you think about, as we normalize out of this, whatever the heck that looks like, balancing growth and credit, and how is this experience that you went through going to potentially impact how you think about that on a go forward basis?
Yes, it's a good question. I mean, number one is we're not going to chase growth. Like we are going to be 100% certain if we ever go for growth again, that the credit will come through and it will be tested into at an amount where, and then we have to feel real comfortable and a high level of conviction and confidence that the credit's going to be there. We're not there yet. It's measured growth. So what's interesting is a lot of people come to me and they make good points. They say, hey, Todd, are you getting a lot of low risk customers now because there's tightening going on at the banks, which filters down to Upstart Lending Club One Main, which filters down to us? And I said, absolutely. I think this is the highest percentage of segment one customers we've originated in a year. The issue, though, is we've had to tighten much greater on the other side of it. So that far outweighs, obviously, the benefit we're getting from lower risk customers coming in on segment one. A lot fewer ones are coming in than cutting off segment four, right? Segment four is a large swath. And this is the challenge I face is these segment four people need, right? They need the credit. This is the time where I want to be there for people, but we have constraints, right? Our bank partners, they're the lender. Ultimately, they decide, right, what kind of business or what kind of metrics we want to run or who we want to, give credit access to. And we have to comply. And also, there's lenders, there's other parties involved. And so it's always a rub that like tightening credit is against our mission because our mission is to provide more credit access. So what I am proud of, though, is we have found people in these segments that with other data available to us, a lot of it's through the banking data, have been able to say, hey, this person may look like this, but they actually perform like this. And so we've done a lot of those, not just credit tightening, like that's like swap in, swap out type of stuff where we're seeing through a lot of the noise and being able to, just because we have a lot of data and we can call on almost 7-8 years of bank data that we have stored from our customers and actual performance, their actuals, that we can continue to expand credit access. So what I said was great. We tightened to stem the problem quickly last year. I said, now we got to find ways to add back, right? And continue to get credit access at the same or lower delinquency rate. And so we've been able to do that successfully. And credit, Chris McKay, who I actually hired the first time around, has been with the company for 10 years. He's our credit analytics, chief credit analytics and underwriting officer. And so, it's been great to work with Chris again and the team and be able to, find new ways to expand credit access. Also from a geography perspective, right? We've been able to open up a couple more geographies with bank structures. And so, proud of that as well. And, making sure customers have options in states.
With regard to the bank partnerships and how much say they have over whether or not credit is extended, it seems to me that the accounts receivable and a lot of the economic risk resides on OppFi's balance sheet. Is that true? Am I correct in that?
For the most part, that structure, and our view is like the bank has equity in it, so they're aligned, and they have the decision rights, right? So they have the ability to say, hey,
interesting,
how we operate or how we collect or this. They have that say. It's their license, and so they're making those calls. Obviously, we can advise them, but it is the banks. The one thing I'll say though is we on the other side of it, right, know the credit and we know the consumer. We started as a direct lender. We're no longer a direct lender, but that was the roots of OppFi. So we're like, hey, we want to eat our own cooking in a sense, right, and take some economics because we believe in it. And so I think it's an alignment thing, right? And so we feel good about that. Obviously, it was tough last year, and people made the case of, not having a balance sheet's a good thing in 21. And that was like the knock I heard on OppFi was having a balance sheet was bad. Now, no one's saying that now, right? that's not the case anymore. But, we've always done that where we believe in our customers and what we're servicing.
Well, my 2 cents on the balance sheet is the economics are better, and I don't care where some of these other lead gen companies may trade and call themselves whatever they call themselves. But I think I don't understand the multiple that the market heaps on some of the other companies just without a balance sheet. I mean, I get capital light, and I get that whatever. We'll see how it all turns out, but I'd rather own the economics.
Well, listen, when you're growing at a very fast clip and credit's really good and you have buyers for the paper, like no doubt, taking an origination fee up front, right, where you book all the revenue up front and a servicing fee to offset costs, that model can look really good, right? It's asset light. You got, plenty of financing. But the problem is in a market where you're not growing, if you're relying on that origination fee, a lot of your revenue is going to tank pretty quickly, right? And so I think I always thought that a hybrid structure, right, having the ability to do both on the capital markets and balance sheet side is advantageous. So right now there's not a lot of appetite, right, for consumer loans, and originations are way down, right? And so if you don't kind of have a mechanism to continue to originate, your revenue is going to go down and you're going to have trouble maintaining profitability, which I think we're seeing a little bit in some of the peer-to-peer space.
Yeah, I think what's interesting about how your relationship works is it's almost like you're selling an option, for lack of a better term, to the banks. And then if they say yes, you're willing to hold the risk, they hold some of the risk. And then you've got your funding partners on the other side who are enabling you to hold the risk. So there's like a very interconnected way that the banks are actually facilitating access to the credit, but the bank itself, it's a named partner in your 10K, and I used to work there. So, but like BMO, right? Like they are a credit provider for you. They're sort of doing the work of lending to the customer, but they're not, right? They're lending to you, and that helps their capital ratios and whatnot, and they don't have to deal with all the headline risk. But you're like the conduit to make it happen. And it's just interesting how it all comes together.
Yeah, I think it's that, but it's also this is not just a FICO score, right? Like lending when you're primarily verifying income and FICO score, right? The value is really on the low cost deposits and the customers, right? Having those customers and then providing a product to them that's pretty standardized. When it comes to our underwriting model, right, we're factoring in, we're using, other bureaus, right? They're owned by the large bureaus, but they're like other data sets like Clarity, Factor Trust. Factor Trust is owned by TransUnion, Clarity is owned by Experian. And we're taking that data, we're taking application data, and then we're also taking the bank data and we're combining it. So the infrastructure and ability to process that and then score it, right, and service it, I'm not sure the banks, right, and frankly, the loans are small, right? So it's not interesting for them at the unit level, right? And they have the ability to kind of, be able to, and then obviously losses are higher than prime. So some of them just have trouble with that. So exactly though, but I think a lot of banks are open-minded and know there's a need for this type of product. Like US Bank has a product that's like a 80% APR product. It's like a payroll advance product that they're doing. It's fee-based though. It's not a stated APR. But they're customers that from what we can tell appreciate it and like it, right? As a way to bridge the gap between payrolls, a lot better than these other options out there. So there are some banks starting to, really, service this and figure out ways. I do think just like in small business lending, and I've talked a little bit about that as a potential parallel product that we see a lot of the same dynamics as consumer. When you get smaller amounts, like the working capital amounts and the amounts, it's not really at risk for being serviced by big banks, right? It's just, it's too small. And the process of underwriting is a little manual for them. And so that's why they need partnerships like us.
Yeah, and I would imagine that they're holding less capital against the loans that they give to you than they otherwise would. But I've never seen consumer. I don't know how much capital you hold against consumer loans, but that's my sense.
Yeah.
So what's next? What's the next 5 years? Like I give you a dream. This is bound to go wrong. No one listen to this. This is not a projection. This is nothing of the sort. I'm just asking you, where would you like to take this business? And what do you hope happens in the space that you operate in?
Yeah, we've gone public, and besides the offering, we've gotten none of the benefits of being public, right? And so I'm excited to explore, the public markets and use the public markets to our advantage with a good balance sheet. If your equity appreciates, you can use that as currency. But I think we're going into an environment where inorganic acquisitions are becoming very attractive. You can kind of find situations of products that we deem to be, good growth ever. So it diversifies the business from a regulatory footprint, right, for being all consumer. Partnering with banks again, we can do the same type of structure, which we know so well, but on the small business side of the house, where I think there's been very little innovation in small business lending on the working capital side. Like there's some ones that have started to take market share through factoring and other forms of small business, but just a true working capital product that has some of the product features that you don't see in merchant cash advance and some of these other products, and that you see a highly fragmented space. I mean, we have the TAM at $30 billion a year for kind of small business sub $50,000 loans. And so there's a big opportunity for a scaled provider. And the way it works is like, and this is kind of when Jared came in the first time, you get to like 20, 30 million receivables, right? And you have this really nice small business, right? That's profitable. And you don't really need like a full management team to run that, right? You need a general manager and some professionals underneath to be able to run that and kind of stay below the radar. And you get very comfortable, right? You can make money and you can kind of have this annuity type of business where you're a small player, but you're very happy. At that point, you need to double down and reinvest. And that's what we did at OppFi, because the mission was never just to help people in Illinois and Wisconsin or Missouri. It was to go national and solve the 60 million problem. That was always our goal. But you do have to redouble down after getting to like a stable point to invest in management, invest in compliance, regulatory, technology, all those functions. And the investment's pretty significant. So, we got there and now we have that scale. So there are smaller businesses like that, right? That are good unit P&Ls, good brand, good customer service, that need our scale and our ability, right, to be able to kind of get to the next level. And we're well positioned to kind of help that. It could be a good partnership. So we're looking at some options in the small business space, and hopefully we can find something that makes sense for us and for our brand and our alignment of credit access, right?
Yeah, well, I hope for your sake that you can thread, and I know you can. I truly believe that you can if you just do it. If you thread the needle between not getting into this trap of quarterly, I mean, you got to beat and raise, and you have, but like, I hope that you as a CEO of a public company that kind of doesn't need that bullshit in your life can figure out how to avoid that while staying public, because I think that the right communication strategy can go a really long way. You end up with the shareholders that you deserve. I know some of the people that you talk to after the calls, and I think you probably got a pretty good group of people behind you. So I think if I had any advice worth listening to, it'd be focus on the underlying business and let the public markets do what they do and use them as you can. But I don't think your time is best served worrying about quarterly results. And I don't know that the business is either.
Yeah, but, I think like we've had to do some of that to build the trust. But I agree with you. Like once you build the trust and you got a group of solid investors behind you, right, they're going to be more open to you investing, right? Or taking some profit and investing, or, working to develop another product for the long-term vision of OppFi to be this mission-driven servicer to the banks, right? For multiple products, right? As opposed to kind of a monoline business that we are today. I think you'll get that permission as long as you're, like you said, transparently communicating it and delivering, right? And I think you'll start to build trust, and people will, be able to say, hey, we actually trust that Todd and his team and OppFi can invest this prudently and generate stronger returns in the future and de-risk the business, all at the same time.
Yeah, and I guess, it's tough when SPACs have kind of a negative connotation to them as is, and then you come out and you miss. So, but you're doing what you can to rebuild. And I one of the major reasons that I said it before, I'll say it again, that I've wanted to interview you is you saw a situation, you came in, you took control of it, you did what I thought was the right thing. And I have a lot of respect for you for doing it. And I appreciate what you're doing, man. You're out there, you are the man in the arena, so to speak. And, I truly, I said this to Jared, and I'll say it to you, I'll say it again and again. I truly hope that you guys accomplish your mission, because I have morphed on the issue of high interest rates, and I hope more people use the product, use it wisely, have their credit repaired, and can graduate to the other side of financial life.
Thank you, Bill. That means a lot. And I know you've been a supporter of ours from the early days, and appreciate, having me on and telling my story a little bit and kind of telling people more about OppFi and the credit access issue in America.
Well, I look forward to doing it over the years, man. It'll be interesting to see where it goes.
Absolutely. Looking forward to it.
All right. Thanks for your time, Todd. Take care.
All right, Bill, take care.